Hi, I'm David Hardesty, and in this lecture we examine the basics of state income tax nexus. The objectives of this lecture are to understand the general requirements for state income tax nexus, to understand economic nexus, to understand the way in which nexus is determined for sellers of tangible personal property, to understand the way in which nexus is determined for sellers of other than tangible personal property, including services, and to understand the entity isolation using intangibles. Let's now examine the basic nexus requirement. A state cannot impose its income tax laws on a seller unless that seller has substantial nexus in the state. This prohibition stems from federal law, namely the U.S. Constitution. What this means is a seller's presence in a state must be sufficiently substantial that the state has the legal jurisdiction to tax the company. Whether a company has substantial nexus in a state depends on a number of factors included in state law. It may depend on the extent of business activity in the state, whether the company has personnel in the state, or whether the company has property in the state. State rules are different from one another. As bright line tests for substantiality, a number of states use sales, payroll, and property thresholds, which, when exceeded, result in nexus. For example, if a company's sales to a state exceed a certain amount, the state will assert nexus. As we will see, the nexus determination depends in part on whether a company is selling tangible personal property. In such case, Public Law 86-272, which is federal law, provides a nexus safe harbor for sellers whose only activity is soliciting sales in a state where orders are approved out of state and delivered from out of state. If a company is selling other than tangible personal property, then there are few bars to finding that the company has nexus in the state other than that its business activity in the state must be substantial. Some states argue that nexus requires only regular and continuous commercial activity in the state. Whether this level of minimum contacts with the state is sufficient is not clear. Many states assert income tax nexus based on economic presence. The states may also have other criteria for nexus. Economic nexus ordinarily results when a company has substantial economic presence in a state. Nexus often results when a company surpasses one or more of the state economic thresholds, which are sales, property, or payroll. Each state has different threshold amounts, which are often adjusted for inflation. Examples of thresholds include the following. Sales to customers in the state exceed the lesser of $500,000 or 25% of total sales. The value of real or tangible property of the taxpayer in the state exceeds the lesser of $50,000 or 25% of total real or tangible property. Or compensation paid in the state exceeds the lesser of $50,000 or 25% of total compensation. Here are examples of economic nexus. Webco, an online retailer, has total sales of $1 million and sales of $300,000 to state A. Under the above sample thresholds, it has nexus in state A. Service Co. has total sales of $10 million and state A sales of $450,000. It also has equipment in state A used to provide online services with a value of $250,000. Under the above sample thresholds, it has nexus in state A based on the presence of its equipment. Now let's look at special rules for sellers of tangible personal property. Sellers of tangible personal property are protected from Nexus in a state by federal law, Public Law 86-272. This law overrides all state income tax Nexus laws. Public Law 86-272 provides that a seller of tangible personal property does not have Nexus in the state if its activities in the state are limited to the following: solicitation for sales of tangible personal property, where the orders are approved or rejected outside the state, and purchases are delivered from outside the state. As we will discuss later, the presence of the protections of Public Law 86-272 make it very important to know whether an online seller is dealing in tangible personal property. It is important to recall that if a company's only activities in the state is solicitation of sales of tangible personal property, then Public Law 86-272 prevents Nexus. In a statement, the Multi-State Tax Commission, or MTC, addresses activities conducted via the Internet and their impact on Public Law 86-272 protection. The MTC takes the position that when a business interacts with a customer via the business's website or app, the business engages in a business activity within the customer's state. It does not matter where the web server is located. Where this activity goes beyond mere solicitation or activities ancillary to solicitation, then Public Law 86-272 protection is lost. States are free to adopt this position or not. This position is effective only when adopted by a state. According to the MTC statement, activities of the business taking place via the Internet do not defeat protection of Public Law 86-272. That is, immunity from Nexus still exists in the following cases: activities limited to solicitation and sales of tangible personal property. The business offers for sale only items of tangible personal property on its website. The website enables customers to search for items, read product descriptions, select items for purchase, choose among delivery options, and pay for the items. Nexus also still exists if the business places Internet cookies onto the computers or other devices of in-state customers, which gather customer information that is used only for purposes entirely ancillary to the solicitation of orders for tangible personal property, such as to remember items that the customers have placed in their shopping cart during a current web session, store personal information of the customers, or remind customers of previously considered items. Immunity still exists if the business provides post-sale assistance to in-state customers by posting a list of static, frequently asked questions with answers on the business's website. According to the MTC statement, activities of the business taking place via the Internet defeat the protection, that is, protection is lost, from Public Law 86-272 in the following cases. The business provides post-sale assistance to in-state customers via either electronic chat or email that is unrelated to the sale itself, such as how to use the item purchased. Protection is lost if the business solicits and receives online applications for its branded credit card. Protection is lost if the business website invites viewers in the customer's state to apply for non-sales positions with the company. Protection is lost if the business places internet cookies onto the computers or other electronic devices of in-state customers, which gather customer information about searches that will be used to adjust production schedules and inventory amounts, develop new product, or identify new items to offer for sale. Protection is lost if the business remotely fixes or upgrades products previously purchased by its in-state customers by transferring and transmitting code or other electronic instructions to those products via the internet. Protection is lost if the business offers and sells extended warranty plans, not tangible personal property, via its website to in-state customers who purchase the business's products. Protection is lost if the business contracts with a marketplace facilitator that facilitates the sale of the business's products on the facilitator's online marketplace, and the marketplace facilitator maintains an inventory of the business's products in the state. And protection is lost if the business contracts with in-state customers to stream videos and music to electronic devices for a charge. Now let's turn to the Nexus for service providers. The first thing to know is service providers are not protected by Public Law 86-272. In addition, while physical presence in a state can often result in income tax nexus in the state, physical presence is ordinarily not required. A service provider will often have nexus for income tax in a state if it is merely doing business in the state. Accordingly, it is possible that any regular and continuous activity in a state has the potential for causing the seller of services to have state income tax nexus. Many states have payroll, property, and sales thresholds that create bright line tests for nexus. Here's an example of a service provider's nexus. Webco provides streaming services to customers in State A via the internet. It has a single employee in the state earning $125,000 per year working from home. It also makes sales to customers in the state of $1.2 million. State A has a nexus threshold of $50,000 for payroll in the state and $500,000 for sales in the state. Webco has nexus in the state under either the sales or payroll thresholds. As discussed earlier, Public Law 86-272 applies only to sales of tangible personal property. What is tangible personal property for this purpose? The states do not provide us with a good definition of tangible personal property for this purpose. Sometimes it is obvious that an item sold is tangible personal property. For example, a book shipped to a buyer through the mail is tangible personal property. The provision of online services, for example, personal services, is clearly not tangible personal property. States have not generally told us whether digital products, such as downloaded books, videos, or software, are tangible personal property for purposes of Public Law 86-272. We do, however, have indirect guidance on this question in the form of regulations issued by the Multi-State Tax Commission on the apportionment of sales of digital property. In states that have adopted these regulations, digital property sales are ordinarily apportioned using the rules for other than tangible personal property. This regulation, when adopted by a state, may imply that digital property is not tangible personal property for purposes of Public Law 86, 272. Here's an example of an online sale of digital property. Webco sells both physical books and digital books from its website. Physical books are clearly tangible personal property. State A has not provided guidance on the character of digital books. State A has, however, adopted the MTC regulations on income apportionment as they relate to digital property sales. Given that regulations treat digital property sales in the same manner as sales of other than tangible personal property, Webco should be wary of assuming that digital books are tangible personal property and should contact the state for specific guidance. Let's take a look at the special case of a seller of both tangible personal property and other property. Consider an out-of-state seller of software that is both delivered in a box and downloaded from the seller's web server. As discussed earlier, a seller of tangible personal property is protected by Public Law 86-272. This protection will apply to sales of software that is physically delivered. On the other hand, Public Law 86-272 does not protect sellers of other than tangible personal property. If downloaded software is not tangible personal property, then sellers of such software are not protected. If downloaded software is not tangible personal property, the seller does not have the protection of Public Law 86-272 and as a result has nexus in the state. It has nexus for all purposes. Thus, if the same company sells software delivered in a box, the seller has nexus in the state for these sales, since the protection of Public Law 86-272 was lost as a result of the seller's other activities in the state. Here's an example of a seller of tangible personal property and other than tangible personal property. Webco sells both physical books and digital books from its website. Assume the digital books are other than tangible personal property and therefore are not covered by Public Law 86-272. Also, assume that Webco's sales to State A total $750,000 and that State A has a nexus threshold of $500,000 for sales. Since Webco meets the sales threshold and its activities in the state are not limited to the solicitation of sales of tangible personal property, it has income tax nexus in State A and all of its sales to that state are taxable. Let's turn to presence in a state. The presence of a company's employees or agents in a state can result in nexus if, depending on the specific state rules, they constitute doing business in the state or property or payroll thresholds are met. Although such presence does not result in nexus if the requirements of Public Law 86-272 are met. Employees in a state can include telecommuting employees. The effect of such employees is far from certain, but there is a clear risk of such employees creating nexus. As an exception, a state may disregard the presence of telecommuting employees under special circumstances. For example, in many states, telecommuting did not automatically result in nexus if such telecommuting was due to the stay-at-home requirements during the COVID-19 pandemic. The presence of a company's intangibles in a state can cause nexus. Thus, the regular and continuous use of a company's trademarks in a state can cause the company to have nexus in the state. A special problem for online companies is the presence of a web server in a state. It is unclear whether the presence of a web server in a state will by itself cause a company to have nexus. There's no general requirement of physical presence for substantial nexus, but individual state rules may require it. One thing that is not clear is whether Nexus requires physical presence in a state. In some states, courts have ruled against a physical presence requirement, and such rulings seem to have stood. However, in other states, physical presence has been a requirement. Thus, the question of whether physical presence is required is decidedly unclear. However, with many states asserting nexus based merely on the amount of sales in a state, the physical presence requirements begin to be moot, except for sellers with low sales. Even if physical presence is a requirement, sellers can be surprised by what courts may deem to be physical presence. For example, in New Mexico, the presence of an out-of-state company's trademarks, intangibles, in the state constituted physical presence. A technique for reducing state income tax is entity isolation using intangibles. Entity isolation using intangibles generally involves organizing a corporation, the Intangibles Holding Company, or IHC, to own and manage intangible assets, such as trademarks, in a state that does not tax royalties received from the license of intangibles. The technique can also be used with other types of intangibles, or even intercompany loans, depending on what type of income a particular state does not tax. A related operating company, or OP, in another state pays the Intangibles Holding Company a royalty for use of the intangibles. The operating company gets a deduction for the royalty paid, and the royalty received is tax-free to the Intangibles Holding Company. The result is an overall reduction in state income tax. Here's an example of the use of entity isolation involving intangibles. Clicks and Mortar Inc. is a successful retailer that operates retail stores throughout the United States. It also sells products online. The company incorporates a wholly owned subsidiary in Delaware and transfers its trademarks, trade names, and service marks to that company. Clicks and Mortar Inc. pays the Delaware company a royalty for use of the intangibles by its stores across the U.S. and by its online store. It deducts the royalty payments from its income for state income tax purposes. Delaware, however, does not tax the royalty income. The net result is a reduction of state income tax. The states have many methods of defeating the use of intangibles holdings companies. Sometimes they are effective and sometimes not. In Jeffrey versus South Carolina, South Carolina unsuccessfully tried to find that a Delaware Intangibles Holding Company was taxable in South Carolina on royalties earned from a related South Carolina operating company's use of intangibles in that state. It argued that the presence of the trademarks, which are intangibles, in South Carolina was sufficient to cause the holding company to be taxable in that state. The state lost its argument. Later courts have come to a different result. Notably, New Mexico successfully taxed an intangibles holding company organized in Michigan that licensed the Kmart trademarks to operating companies in New Mexico. The entity isolation technique works where the intangibles holding company and the operating companies file separate state income tax returns. In states that require combined returns, there is no benefit to the technique since all of the royalty income is captured in the combined return of the operating company. Some states defeat entity isolation by denying a deduction to an operating company for payments to a related company with respect to the use of intangibles.